Hello, this is Joe Hoyle speaking to you for CPA Review for free. In this video, I want to look at a question for the Financial Accounting and Reporting section of the CPA exam. More specifically, I want to demonstrate how to do an earnings per share question. Because all publicly held companies must report earnings per share, the examiners will expect you to be able to work questions in this area. And you can do this. The computations are never easy, but they clearly follow a specific set of rules that you can do. These are points that you can get. These are points that you should get. As always, let's begin by reading the question. And we'll try to make note of those things that you should look for in working an earnings per share question. The Smollett Company is publicly held and has 20,000 shares of preferred stock. Now remember, publicly held is important because those companies must report earnings per share information. So that means that the earnings per share information is required. There's 20,000 shares of preferred stock outstanding and 100,000 shares of common stock. Preferred stock pays a $4 per share dividend. That's an important piece of information. While common pays 60 cents per share. Net income for the year is $600,000. The effective tax rate is 40%. In many earnings per share computations, the effective tax rate is important. As we'll mention here, it is not used, but it is in the problem just to get in your way. Each preferred share can be converted into 2.5 shares of common stock. What is basic earnings per share? That's the first part of the question. And diluted earnings per share, the second part. And as always on the CPA exam, you have four possibilities. A says $4.60 and $3.60. B says $5 and $4.20. C says $5.20 and $4. And of course, D says $5.68 and $3.79. In any computation of earnings per share, you should begin by calculating basic earnings per share. That's where you start with basic earnings per share. You have to arrive at that number before anything else can be done. Always remember that earnings per share always refer to common stock. We're dealing here with common stock. The amount that preferred stock is entitled to is stated in the contract. Common stock is a residual ownership and gets what is left when everyone else has gotten their share. The purpose of the computation is to let interested parties know what that residual part is. After the preferred stockholders have their part, common stock gets the rest. And we want to know what that rest amount actually is. In basic earnings per share, take the net income, which is $600,000 in this problem, and subtract out the preferred stock cash dividend to arrive at the net income that is left over for common stock. Here, preferred stock gets $80,000, which is the $4 per share times 20,000 shares. That's the preferred stock cash dividend. The common stock dividend then is the $600,000 less this same $80,000, which leaves $520,000 for the common stockholders. Now, how many shares are there? There are 100,000 shares of common stock. In doing an earnings per share computation, you use the weighted average number of shares outstanding for the entire year. Here the number was apparently 100,000 for the entire year. No average can be calculated or needs to be calculated. You know the number is 100,000. So we now know that the net income for common stock is 520,000. You've got that number. And the number of shares is 100,000. Therefore, the basic earnings per share in this question is $5.20. That tells you that the answer is going to be C, because only C has $5.20 as the basic earnings per share. Now, we're still going to calculate the diluted earnings per share to show you how it's done. But you can tell in this problem by just doing basic earnings per share what the answer is. The answer is C. Diluted earnings per share is often referred to as a worst case scenario. How low would earnings per share fall if all of the convertible items were actually converted? This is a hypothetical situation. What happens if the preferred stock shares, which is your convertible here, are actually converted into common stock? U.S. GAAP sets up specific steps that must be followed to determine this impact. All of them begin the same way. They all begin with assuming the convertibles are converted. So we're going to take the basic earnings per share, convert the convertibles or assume conversion, and then we're going to determine diluted earnings per share. This company has one convertible, the preferred stock. If those 20,000 shares of preferred stock were to be converted, because they're converted at a rate of 2.5 shares of preferred for every share of common, then that means that you would have 50,000 more shares of common. So if we start by assuming conversion, then what we say is the common stock is going to grow from 100,000 to 150,000. Are they really converted? No, that's not the point. The point is that if they were converted, what would the impact be? What else do you assume if you assume that the preferred stock is converted? We would also assume that the dividend would not be paid. If the stock was converted to common stock, you would not pay the preferred stock dividend. That saves you money. So therefore, the net income for common stock, which we've already computed for $520,000, would go up to $600,000 because you're adding in that $80,000. You assume conversion, you add in the shares, and then as you can see here in this slide, we save the dividend. That's how you convert a preferred stock for the diluted earnings per share computation. Notice in this previous computation that we did not take the tax effect into consideration. The reason is that preferred stock dividends that you pay, or any dividends that you pay, do not have a tax effect. So whether you paid those $80,000 in dividends or didn't pay the $80,000 in dividends, it makes no difference in the computation. In some other parts of earnings per share it will, but in this one it won't. So what do we know now? If we assume conversion, then we know that the earnings will be $600,000, that's $520,000, plus the $80,000 in dividends saved, and the number of shares will be 150,000 shares, which gives you a diluted earnings per share of $4. And as we have said before, we know that the basic earnings per share is $5.20. We know that the diluted earnings per share now is $4. So again, what we knew before was that the answer is C. If the conversions were to be made, then we would assume that the earnings per share would drop from $5.20 to $4. That's information that investors want to know. There's one more point that I think you really should know about this problem, and that is that the difference between dilutive and antidilutive. The preferred stock caused the earnings per share to go down. It is referred to then as a dilutive effect, and you always include the impact of all such dilutive effect. On the other hand, it could have caused the earnings per share to go up. It would have been viewed in that case as antidilutive, and if it's antidilutive, then you do not use it in the earnings per share computation, and the convertible item is ignored. Dilutive is included, antidilutive causes earnings per share to go up, and it is ignored. This is Joe Hoyle for CPA Review for Free. I think you can see that this is a computation that you can do, and one that should help you add the points you need to pass the financial accounting and reporting part of the CPA exam. Good job. Keep working and you're going to get those 75 points and pass this exam. Have a great day.